Hey, very good morning to you traders. Mark here from Day Trading Room. A long time since I've done a video. There are some other videos from HIP on the site which are well worth a look if you haven't looked already. But anyway, this video is really about answering some of the emails I've had. I've got a range of emails asking about the tape, other aspects of charting, price action, and other people just inquiring where I am. So I'm going to run through those today. And that's generally going to be what I think I'm going to do moving forwards. If you've got any questions for me, please feel free. Contact form on the website, fill out that form, or if you've got the email, send it through, and I will answer them on YouTube on these videos because it's going to benefit everybody. A lot of the questions are of similar nature, so it helps everybody, and it's easier for me as well. I'm not talking about things, and I can show things on charts as well. It's probably a more comprehensive answer. So if you've got a question, feel free to email me. If it's aimed at HIP, the other trader who does the videos as well, then just mark it for him, and I'm sure he'll answer as and when. So the first question is some of you guys saying, where am I? Well, some of you know I decided just to take a break for a while. I've been trading for 13 years, and I looked around and I thought, you know what, I haven't actually taken a long break from the markets. I've been on holidays, etc, etc, but I haven't actually just stepped back and just relaxed for a few months and not been involved in the market. So that's exactly what I'm doing, and it's probably the longest, in fact it is the longest time in my 13 odd year career of trading that I haven't placed a trade. And the markets are reasonably quiet as well. The volatility is quite low. I don't feel compelled to get back in, so just enjoying a bit of time off. I will definitely be back, but at the moment just relaxing, enjoying some time away. I'm checking every day. I do look in every day at the markets just to keep my touch of what's going on the price levels we're at. Obviously not as focused as I would be if I was sitting here as normal in front of the screens, but I do check in and see what's been going on just to keep my eye in. And it's quite interesting actually from a perspective of looking in when you're not trading but you're just reviewing things from a completely independent perspective. It actually takes a different it gives you a different view on things, and often I'm doing other things and I'm thinking about strategies that I'm perhaps going to implement when I come back, some ideas I'm going to look into when I come back in, and it's quite good actually for seeing things completely differently. And I remember speaking to a trader who'd been doing it for 33 odd years, and he used to take quite regular long breaks from the market, and he said actually from a market perspective, obviously from a perspective of him being able to do other things other than trading, it was great, but also from a trading perspective, he always said that when he came back after a several month break, he felt really refreshed and really ready to get into it because he looked at things at a different perspective, etc. So that's pretty much what's going on with me. Okay, so let's answer some of these questions. Thanks for your questions, guys. By the way, the room, if you want to sign up for that, I've got a big waiting list there. I'm going to try and hopefully soon enough organise it so I can get some more people in there. If you're not on the waiting list, then you can go and sign up for that. Make sure I've got your email on there, so when we do expand it and we do have the facilities to take more people, then I can send you the email. Okay, so let's get to these questions. One of the questions, the recent one actually, was on the VWAP pullback trade. Thank you very much for your question. I haven't got it in front of me, so I'm not sure who it's from. Apologies, but thanks for it anyway. Okay, VWAP pullback trade. Traditionally, or strictly speaking, it is if you've got a big push away from the VWAP, and I'd say the dotted line here is the VWAP. I'll try and draw it by hand. You get a little bit of a counter trend pullback, and then you get a deeper pullback to the VWAP, so that's the VWAP there, and you're taking a trade back in the direction of the trend. The idea is you're looking for that unwinding. Now at the moment the market's a little bit quieter, so you're not getting the big extension, but you can see here, if you just eyeball the charts from the past sort of week or so, how useful the VWAP has been. The extension away, pulls back to, holds, pulls back to, holds, pulls back to, holds. It's quite a useful tool. Obviously that's very quiet on the Friday. The question is, which time frame do I use for the VWAP pullback trade? Now it doesn't really matter, is it 5 or 1 was the actual question. It doesn't really matter which one you use. Obviously, a 5 minute is going to give you a better perspective than if you're running from a smaller amount of maybe one or two screens. Then you don't want to have loads of charts on, but you want to use the optimum thing. So what I would recommend is using a 5 minute or 15 minute to gauge where the VWAP is in conjunction with the market, with the prior day's action, etc. And then as the market approaches it, and let's say you're looking to take the trade, drill down perhaps to a 1 minute then, so you can get each individual candle, and then when you're ready to take the trade and it's at the VWAP and you're looking to execute, then that's when you drill down even further and look at the tape. So we're not looking at really short time frames all the time, but we're looking at larger time frames, and then when the market comes to a level that we're looking to execute, then we can drill down to the lower time frames and even then right into the granular tick level to then place the trade if it's setting up right. But the VWAP is it's a very important tool. It's a benchmark for institutions when they're placing trades. If they are longer term guys who are looking to buy the S&P for whatever, if it's a reasonable size order, they'll look to spread it out throughout the whole day, so they're getting as close to the VWAP as possible, or trying to beat their VWAP. So some guy may give a broker an order and say, hey, can you fill this throughout the day, and I want the VWAP price, and nowadays they'll plug it into an algorithm and it will just trade based on how far away it is from the VWAP. And actually that's why you get this sort of action. You get extensions away from the VWAP, which is one particular urgency of time frame player, but then there's nobody else to get involved. When there's no catalyst, there's nothing else, no other reason to chase, you've got a lack of buyers, because the people who are trading trying to get the VWAP or a nice average price aren't buying up there, or they're very, very lightly buying. And as the price pulls back towards the VWAP, they start to pick up their buying, and then when it tags the VWAP, they're buying more aggressively to fill that order, because the price is actually at the VWAP. And that's what they're trying to do. They're trying to beat the VWAP. There's no point in them buying up here, because their average price is going to start to move up away from the benchmark they're trying to achieve. So as it comes down, the algorithms start to get a bit more active, which is why you find support here, and why you find quite often the market closes at the VWAP, because just buyers just drying up as it extends away from it. When you haven't got any other catalyst, when you haven't got any other news flow, when you haven't got any other reason for people to be involved in the markets, you've just got a general mean reverting type environment, and that's why you get that. So it's a useful tool. If you're not sure about it, I think the best thing to do is go onto Google and have a look and see how it's constructed, how it's made up, and find out some more about it rather than me talking about it here. But it's a good tool to have, very useful, a good way to get you involved in the market on a counter trend move if you're not quite sure the best possible place to do that. It just gives you an idea of where to start looking at the tape, where to start tuning in to possibly get involved in the move, if you already earmarked it as something you want to be involved in. Okay, next question quickly is where can I get free time and sales and free market depth from? I don't know anywhere you can get it for free from. However, you can get it, I know that Interactive Brokers will give it you for free if you're a brokerage customer. I think it's free. It may be there may be some sort of level of activity involved in it, but you can get the time and sales, and you can get the market depth, which you can then feed into. You can either use their native one, which isn't very good if I'm honest, or you can feed it into something like Ninja. That's quite a cost-effective way of doing it. TradeStation, you have to pay for the market data feed, and you have to pay for the platform, although it is free if you're a brokerage customer and you do, I think, 10 round turns a month. Kinetic is another data feed, independent data feed. I'm not sure how much that is, but I'm sure you can probably just subscribe to one exchange and then bolt that into NinjaTrader, which is free if you don't use it to execute through. So that's one way of doing it. But I don't know a way where you can just get it for completely free. There may be somewhere out there. You may be able to speak to a broker and say, can I try it out? You may be able to get a trial or something like that for a couple of months and use it like that and bolt it into NinjaTrader or something like that. But it's one of those things that it's probably worth paying for. You don't have to pay a lot for it. and it's one of those things that if you're running a trading business and you're interested in getting involved in trading, looking at the time on sales, looking at the tape, and that's one of the skills you'll want to add to your trading arsenal, and it's well worth putting aside a bit of cash for a couple of months, so that you can really study it hard and really get in tune with it. It's not very expensive in the scheme of things. I understand people want to keep costs down, appreciate that 100%. You've got to keep your costs down whatever business you're running, but it's one of the things that is probably worth paying for if you can find a reasonable, I'm sure it's pretty reasonably priced out there. It's not through the roof, so it's one of the things that's worth splashing out for if you're interested in reading the tape. Okay, final thing is, I'm waffling on a bit here, final thing is keep the risk managed, guys, because don't get lulled into a false sense of security in these markets. The quiet markets can lull you into a false sense of security. You've been mean reverting trade, you're fading levels all day long or for a week long, and all of a sudden you get a range expansion and you're caught out because you're not used to it. So always bear in mind, go back and see how vicious the markets can be when they want to be. Just because they're quiet now doesn't mean you can't get some sort of catalyst that comes out, or it doesn't even need a catalyst. You could just have one huge trend day just come out of nowhere. This is how the markets work. Volatility cycles, range cycles, everything moves in waves. So we always tend to put risky markets as volatile markets. Is not necessarily the case. Okay, you're not going to get your face completely ripped off with a very quiet market, but you've got to be careful what you're doing. Your position sizing has got to be careful. Blindly adding to positions is a dangerous game in a quiet market, because it could just look as if it's mean reversing. You could be adding to it around the core, and then it just keeps going away, stretching. It will just creep and creep and creep and creep, and you get caught out like that. Or your stops could be too tight and you get the death by 1,000 cuts type scenario. So I think just being cautious. It's quiet, yes, but it doesn't mean it's any less risky. It's just a slightly different risk to a really volatile market. As long as you appreciate that and understand that, then you'll be fine. At the end of the day, that's the most important thing, is keeping that risk managed regardless of the market conditions. So feel free to email me, contact form on the website, and send it through, and I will do another video with some of your questions, answer them there. And if I can help, I can. If I can't, I shall try and put you in the direction of a site or somebody who can. Take care. Enjoy your trading.